Hello everyone, so today I'm going to show you how to figure out what the actual inflation rate is. I know on the news it's always saying like, oh, the inflation rate rose up 7% this year, or this percentage this year, but in reality it is a lot worse than that. The inflation rate for between 2021 and 2022 is at least 11%, and the way to figure that out is just to go to tradingview.com and then type in WM2NS. This measures the M2 money supply of the US dollar. So think about it as the US dollar market cap, and functionally it's the metric to use whenever you try to evaluate your investments. So using this chart, we know that since let's take January 2021, since 1 year ago, the inflation rate has risen at least 11%, 11.33%. Since March of 2020, when a bunch of asset classes dropped, it has risen 40%. So the reason you need to know this is that you have to evaluate it in relation to all your investments. So let's take this Gemini. Gemini offers 8%. They offer 8% APY, and like that's definitely better than whatever banks offer, right? 1% or 2%. But putting it into context of the inflation rate, if you just left your money and gained that 8% every single, 8% a year, you would have functionally lost 3%. So this is why it's so important that you know what the actual inflation rate is and where to get that information from. Let's take dividends for example, right? So AMT is a REIT, so a real estate investment trust, and they give out dividends. And if you go look at the dividends, go ahead and click on it. They give $1.39 per dividend each quarter, and if you just for simplicity's sake, let's just multiply 1.39 times 4. You'll functionally get 2% dividends. It's like, oh, that's not bad, right? And it's like if you invested since last year, you would think that the price your stock has risen 13%. But let's remove the inflation, right? If you remove the inflation, functionally you would have gained nothing, right? You would have gained nothing on the value of the stock. So you will gain that 2%. So you would have gained 2%. Realistically, you would have only gotten 2%, and that's worse than just throwing your money into the general stock market. That's worse than throwing it into the S&P 500. So this is what the S&P 500 looked like since we just measured it since last year, right? It has risen 21%. That's more than whatever AMT is. So this is the S&P 500 without inflation. And if you just go back 1 year, right? Just go back 1 year. You would have functionally gained 10% versus gaining 2%. So you have to think about it holistically in terms of how inflation affects all of your investments. And you will begin to realize that it's a lot more difficult to figure out what is actually good to buy and what is not. It's one thing to keep up with the inflation. It's another thing to make money, actually gain money. So that's something to keep in mind. Hopefully you found this video useful. Everyone take care.